For those of you who are on the line, please note that this presentation is being recorded. That way we have access to it at a later date, or if anybody who wanted to be a part of the presentation today wasn't able to join, they will go ahead and be able to listen to it at a later time. All right, with that, I am going to go ahead and get started. My name is Jessica Sakash. I do work for HSA Bank, and I do work very closely with your HR team and your wellness coordinator to ensure that we are providing you with all the information that you need, especially when it comes to those health savings accounts. So I'm very happy to be here with you guys today. Thank you so much. Please note that you are on mute, and to enter any questions that you may have into the chat box. We will be looking at those questions at the end of the presentation and answering any questions for you. All right. Well, thank you so much again for joining me today. Like I said, I am very excited to be here and looking forward to being able to share some more information on HSAs with you. As you can see, we do call this presentation From Safety Net to Nest Egg. And that's exactly what we're going to talk about today. What an HSA means for you today, tomorrow, and well into the future. Currently, over 26 million HSAs are open in the US because there's such an effective way to save money. And of course, they put you in control of your healthcare dollars. So what we'll do in this presentation is go over what exactly an HSA is, how it works, and then of course, most importantly, all the ways it can benefit you. We know your health and the health of your loved ones is one of the most important things to you. You're likely focused on making healthy choices from day to day and preparing for the future. And of course, we don't even realize we're making those choices, but we are thinking about it, whether we're consciously aware of it or not. So one way that we can help you stay prepared is by helping you stay in the know, and we will believe that the key is for you to have a strong safety net for the future. Having a safety net for healthcare means you can pay for unexpected medical expenses without disrupting your normal finances. This can be a challenge for many Americans, with 40% never saving for future healthcare expenses and 30% never considering costs before a purchase. If this sounds like it may be you, don't worry, because luckily this is where the HSA comes in. HSAs are designed to be your financial safety net, so you can stay prepared for whatever healthcare needs come your way, and so you can feel peace of mind every day. So health savings account, I know that they are not new to you as a benefit. However, just to kind of recap again what they are a unique savings vehicle. You can use them for medical expenses that aren't covered directly by health insurance. And that also means that you can use it to pay for things like doctor visits, prescriptions, and other medically necessary items and services. And it's one of the most powerful savings tools out there. In fact, an HSA can help you save for more than just healthcare. It can also help boost your retirement savings. Before diving a little deeper into all the benefits of an HSA, I want to make sure that you feel comfortable with the basics of how it works. First, an HSA always pairs with a specific type of health plan, and that's a high deductible health plan, also known as an HDHP. Those are known as consumer-driven health plans. The health plan covers certain preventative services, plus illness or injury after your deductible is met. The HSA can be used to pay for any qualified medical expenses not covered by the health plan. And HSA funds can be used before and after meeting your deductible. It's also simple to make distributions or withdrawals from your HSA. When you want to pay for a qualified medical expense, you typically have a few options for accessing your HSA funds, such as a debit card or online bill pay. You can even reimburse yourself for qualified expenses that you previously paid out of pocket as long as the payment took place after your HSA was opened. You can use your HSA funds for not only yourself, but also your spouse and any tax dependents. When reimbursing yourself for a medical expense, it is important to note that you do not have to do it immediately. You can save your receipts and decide that you want to reimburse yourself a year from now, 5 years from now, 20 years from now, as long as you have proof of what you're reimbursing yourself for. When we say you can use an HSA for qualified medical expenses, we're talking about a list of expenses that the IRS considers eligible. Some common examples can include services like acupuncture. It could include your eyeglass prescription. It could include insulin. It could include vaccines or vision exams. Some things to note that recently, due to COVID last year, it has also become where you can use your funds on over-the-counter items without a prescribed doctor's note. The best way to determine whether something is an eligible expense, if you don't like reading through IRS dialogue, you can use two things. You can go to hsabank.com/QME, or if you use your mobile application, you can scan the items. So when you're in your mobile app, you will see on the home page the functionality to scan items for eligibility. This is really great when you're at your local pharmacy or Target or Walmart and you're not sure. When you pull up this scan for eligibility box, you can go ahead and use your phone, scan the barcode, and it will let you know whether or not it is an eligible expense to use your HSA funds on. So we've talked a little bit about the basics of an HSA, how it works, who's eligible, things of that nature, and how, of course, that it can help build a strong financial safety net. But moving on, there's also a lot of other tax advantages and even extra retirement savings options when we talk to your HSA. I mentioned earlier the importance of having a financial safety net for healthcare. And while we all know it's important to save for rainy days, we get it. Putting money aside for healthcare can still be tough. A HealthView Services study shows that a healthy 65-year-old couple can expect over $600,000 in future lifetime healthcare costs. This is a huge burden for anyone. Fortunately, when you have an HSA, you have dedicated healthcare savings. It's money set aside specifically for your health. which is a smart idea because healthcare costs continue to rise and can be hard to predict. With an HSA, the more you save, the stronger your safety net will be. So if you have sudden medical costs or a change with your health insurance, you know you'll be covered. This may help you avoid going into debt or cutting into your 401k and paying penalties. For many, this is the most meaningful part of owning an HSA, the peace of mind from knowing you're prepared. So putting this into perspective, let's look at an example also taken from the Health View Services study. Suppose you have $100,000 saved in your 401k and another $100,000 saved in your HSA by the time you retire. Both accounts have been funded with pre-tax dollars and have grown tax-free over the years. With the 401k, assuming a 24% tax rate, only $76,000 is left after taxes to pay for health or expenses. But with the HSA, thanks to its triple tax advantage, you can use the full $100,000 for health expenses. Making contributions or deposits to your HSA is easy. And one of the best parts is that anyone can contribute to your account, including yourself, your employer, or your spouse. Specifically, don't forget that Tavistock will match your contributions. If you have any questions on that, make sure to talk to your HR rep. The total contributions to your HSA are subject to the annual contribution limit set by the IRS. You can view the annual limits at any time by going to hsabank.com. And then never forget, you're allowed to catch up on HSAs just like a 401k. So anybody who is over than 55 can deposit an additional $1,000 for that year. Just to take a note, as I know Tavistock plans go from calendar year to calendar year, which is a little different, but just wanted to make everyone aware on the line today that the 2020 maximum for single coverage was $3,550 and family $7,100. In 2021, those have increased. So $3,600 for an individual and $7,200 for a family. And then always remember that extra $1,000 catch-up for those of you 55 and over. So in summary, some of our practical tips to help you get the greatest benefit from an HSA include contributing, of course, right? Contributing as much as you can up to the IRS limit. Make sure you have at least enough funds to cover your deductible. Try not to use your HSA for smaller expenses or anytime you can pay out of pocket. Remember, if you pay out of pocket now because you have the ability to, and you keep that receipt and down the road you're short on funds, you can always reimburse yourself later if needed. That's why it's so important to save your receipts so that you can reimburse yourself anytime that you may need to. And again, that could be a year from now or 10 years from now. Make sure to take advantage of the recurring contributions that you can do through your payroll with Tavistock. Super important. And then, of course, take full advantage of any HSA incentives that you can. And that includes the match that Tavistock provides for you. If you think of your HSA as a retirement account, you can start to think of it more that way. You'll treat it more that way. And with that, once you get to a comfortable place and deposit in your HSA, you can start to consider investing your funds. Reaching your contribution goals doesn't have to be stressful, nor does it have to be something you're bound to put off until the end of the year. That's because you have the option to schedule a recurring contribution from each paycheck, similar to how you may contribute to your 401k or other retirement plans. Many HSA account holders enjoy this option to set it and forget it as a stress-free way to reach their yearly contribution goals. Of course, you also have the option to make a one-time contribution to your account at any time. So whether you want to max out your savings or start small, it's simple to manage your contributions as you like. Now, you might be wondering how practical it'll be to put money aside for your HSA. Well, a high deductible health plan typically has lower monthly premiums than some of the traditional health plans. So you can use the money saved from lower premiums to build your HSA. This way, instead of paying the insurance company larger monthly premiums that might never benefit you, you can put it in your HSA and use it in a way that works for you. Another great thing about HSAs is your funds roll over year to year. They never expire. And since you own the account, you can keep using it if you change jobs, retire, or even if you switch health plans and go back to a more traditional plan that doesn't qualify for HSA contributions. It's always going to be there with you. Another huge way that HSAs can benefit you is they let you save on taxes in 3 ways. First, you don't pay federal taxes on contributions to your HSAs. Second, earnings to your HSA from interest and investments are tax-free, always. And lastly, you don't pay taxes on distributions from your HSA when they are used for qualified medical expenses. This unique triple tax advantage makes the HSA a powerful tool that can save you money in ways that other savings accounts just can't. When you look at the plan options available to you, it's important to consider more than just the premiums, deductibles, and other costs built into the plans. You'll also want to consider factors like your general health, whether you typically meet your deductible, incentives offered by your employer, how much you could contribute to an HSA, and of course the tax savings from using an HSA. Doing the math for yourself is simpler than you might think. To help, HSA Bank offers several tools, including a health plan comparison calculator and an HSA contribution calculator. Both of these are available at hsabank.com. You can also go to the Learning Center on the HSA Bank website to discover more about how an HSA can help you save for the future. Along with saving you money on taxes, HSAs can help you grow your nest egg for retirement. After the age of 65, you can use your savings for any purpose without a penalty. Only income tax is assessed at that point. And of course, you can continue to use your savings for qualified medical expenses tax-free. If you want to potentially earn even more money, you can even invest your HSA dollars as roughly 1 million Americans do today. In fact, many people treat their HSA as a retirement or investment account. An excellent practice is to contribute to your 401k or other employer-sponsored retirement accounts up to the match amount, and then contribute to your HSA up to the annual limit. Remember, the HSA's triple tax advantage means you get to keep more of your own money for healthcare when you retire, rather than pay more in taxes. There are multiple reasons why you should consider investing your HSA funds. Here are a few important notes to think about. The HSA is the most tax-advantaged account in the current tax code. It offers a triple tax advantage, meaning you can put money in, use it to pay for IRS qualified medical expenses, and gain interest on it, all tax-free. You can build long-term savings needed for future medical and retirement expenses, especially with one of HSA Bank's self-directed investment account options, which offer helpful guidance while keeping you in control. There's no use it or lose it policy with HSAs. The money you put in is yours forever and never expires, even if you change jobs or retire. So both your cash balances and your investment balances carry over from year to year and grow tax-free for the greatest potential returns on your HSA dollars. When you have an HSA, and especially when you invest your HSA funds, it can be an excellent complement to your 401k or other standard retirement accounts. In fact, most cases, your HSA is significantly more powerful than a 401k that simply defers your tax liability. There are no federal taxes on contributions, withdrawals for qualified medical expenses, or investment earnings for HSAs as compared to 401ks, which are taxed when withdrawn. Investment options exist for both HSAs and 401ks. Your HSA funds are also easy to access, and there is no penalty for using the funds unless it's for non-qualified medical expenses. With a 401k, you will be taxed and pay a penalty for withdrawing funds before age 59 and a half. If you withdraw your HSA funds after the age of 65 for non-qualified medical expenses, then those withdrawals are taxed at your current tax rate, similar to a 401k. HSAs are not subject to required minimum distributions after the age of 72, and you can save the funds as long as you like. We want to make sure you understand this point. When you use your HSA to pay for qualified medical expenses, and that list of qualified medical expenses expands when you are eligible for Medicare, these funds can be withdrawn with no tax implications. So when you contribute to your HSA, you reduce your taxable income, and when you withdraw funds for qualified medical expenses, they're still not taxed. In addition, with an HSA, you're free to move your funds between your investment account and your cash account. Any funds above $1,000 in your cash account can be invested. HSA Bank provides account holders with two unique self-directed investment options. The first one is our guided portfolio self-directed investment program, which is powered by Devenir. Devenir is the leading provider of HSA investment advisory services. This program provides you with a pre-configured menu of mutual funds selected by a registered investment advisor, or an RIA, whose job is to advise in your best interest. It's easy, low cost, and similar to a 401k experience that you may be familiar with. This option is ideal for investors who are just starting out. On the other half, we have TD Ameritrade, and they offer a comprehensive, flexible, and powerful tool for trading across the entire stock market. This option may suit you if you are a more experienced investor. Remember that with both of these options, investment products are not FDIC insured, are not a deposit or other obligation are guaranteed by HSA Bank, and are subject to investment risk. I want to thank you so much for joining me today and listening to HSAs and how they can help you now and into the future. I hope this overview has been helpful, and if you have any questions, again, please feel free to send me anything in the chat box. Don't forget to watch for your 1099 essays. Those will show your 2020 distributions. Those have recently been distributed. If you did elect to get them online, you'll receive a notification that it's ready, and you can go online and pull that. Don't forget, contributions are found on the 5498 essay. That does not come out until May. Because don't forget, you can contribute to your HSA for the prior tax year up until the tax filing deadline of April 15th. I do see a question, and it says, how much do you need in your HSA account in order to start investing? So we did hit on that for just a moment there at the end. We do expect $1,000 in the HSA cash portion of the account at all times. So anything above and beyond $1,000 you can start investing that. Do you have to invest it all, or can you invest a portion of it? So correct. Since we do have the rule in place to keep $1,000 in the cash portion of the account at all times, you can split your funds. You can keep some in the cash portion and start putting some into the investment. Best practice there would be to keep an amount in your cash portion up to your deductible so that you have that available to you should you need it for that year. And then anything above and beyond that, start putting into an investment account. A few more questions coming in here. Does an HSA allow for CPAP equipment? So CPAP equipment. So great question. If that is something that is a medical necessity, then what you would want to do is always check against the IRS guidance when it comes to what is considered eligible. However, I have experienced this particular question before, and yes, you can use it for that. Right, looking at the next, oh, sorry, scrolling through the questions here. Similar to 401k, is there a target that you should aim for to save in order to have, quote unquote, enough to cover your health costs during retirement? So yes, right now, as I mentioned earlier in the presentation, a healthy couple who, let's say, both retires at the age of 65 and does go on Medicare, based on their life expectancy, will spend roughly $600,000. So that number changes, and as a matter of fact, it's almost double from when I started in the industry about 5 years ago. So it's something to keep an important pulse on, and that's just kind of doing a quick Google search or check in on HSAs, but 600,000, and that's including Medicare costs. So anything that you would have to pay for Medicare out of pocket. So I would say that looking at yourself on, are you married? Are you, retiring earlier than 65, later than 65? Will you be staying on a health plan with your employer after you retire? What kind of options you're looking for. However, like I said, we kind of have a ballpark estimate of what, people are spending. So, it never hurts to strive to be able to cover those expenses, or at least part of them. How do I start beginning to invest? So investing is, you can do it right from your online account, and it says, manage my investments. We also have a really great resource out there. It's a video tutorial. I will be sharing that with the HR team. They can forward that on to anybody, or even potentially post it for you guys to take a look at. But it is a great tutorial that helps you determine. I will say that once you start investing, I would always recommend, if you are a hands-on, you like to, follow the stock markets, and you like buying and selling and trading, TD Ameritrade is going to be the way to go. If you are the type of person that when you go to your 401k, like me, you put in a retirement age and say, okay, tell me what I should do, Devenir is going to by far be the best way to go, because it will give you the guidance and it'll set you up on the mutual funds to put you on that path. All right, a few more questions here. What happens with the funds if the member passes away? Can it be transferred to children over the age of 18? So this is a very, very good question, because HSAs are individually owned by one person. So it's driven by your social, just like a 401k is. So there aren't, joint owner HSAs. It's not they do not exist. So when you have an HSA, what you want to do is first put a beneficiary on your account. The beneficiary is where your funds will go if something were to happen to you. Most states, your beneficiary is most likely going to be a spouse. Or if it's not a spouse, you would have to have spousal permission to have it be somebody else. If it is a spouse, that spouse will have two options. They can either take the funds as a taxable event, or they can transfer it into an HSA in their name and continue to use it just like the owner did when they were alive. If the beneficiary is anybody other than the spouse, that is perfectly fine. You can certainly give those funds to that person, a child over the age of 18. However, it will always be a taxable event in that they will have income tax on it. Unfortunately, we cannot pass them on to our children as an HSA. And just a quick note to follow up on that, beneficiaries, you can do that right online through your account. You can go in, add your beneficiary, and don't forget that you can have authorized users as well. They can have a debit card to use if they're a dependent. But an authorized user is not a beneficiary. Authorized users do stop once the owner of the account is deceased, and that's where the beneficiary comes in. So they're two different things. And then I'm just being asked to provide contact information for a way to have questions for HSA. And I, of course, will make sure that the team gets the right information that everyone needs for those questions. Always feel free to call the number found on the back of your debit card. That will take you to the HSA Bank Client Assistance Center, and they will be able to answer any questions that you have. I received a thank you. Thank you so much for taking the time to spend your lunch hour with me today. I really do appreciate it. I do not see any other questions coming in. So I will go ahead and wrap us up for today. Again, thank you so very much for joining, and thank you to the Tavistock team for inviting me to share this information with everyone. Again, I will make sure that the resources are sent out, and especially around the investing and any information that will be helpful as we move on. All right. Thank you again so much, everyone. Enjoy the rest of your Friday and have a wonderful weekend.